Ind AS 1 is called presentation of financial statement. So it is similar to which Indian GAAP literature? It is similar to Schedule 3. It is similar to Schedule 3 of the Companies Act. And you will find at several places there are a lot of similarities, because this also talks about the same thing, presentation of financial statement. That means how your balance sheet, P&L account, notes to account and statement showing changes in equity will be presented. What about cash flow statement? This standard will not talk in detail about cash flow statement. The reason being, there is a separate standard on statement of cash flow. So therefore, in this standard, basically we will understand the requirement of presentation of financial statement like balance sheet, P&L account, notes to account, statement of changes in equity, but not the detailed understanding of cash flow statement. So as you know, financial statements are very important for the investors. Okay. Financial statements should be prepared in a standardized format. So all companies which are now following Ind AS, you'll find their financial statement is very standardized. It's almost in the same format. So you can compare easily the current liability of one company with current liability of other, profit of one company with profit of other. It is useful for the government agencies also, investors also, bankers also, foreign investors also. Keeping that in mind, the standard has been designed. It is more or less similar to its counterpart, International Accounting Standard 1. So it is very close to IAS 1. There are one or two important differences. Otherwise, it is similar to IAS 1. And on the basis of IAS 1, Ind AS 1 has been designed. Okay. And the standard is very comprehensive. It gives you a lot of details. So much that as a student you might get bored also. But anyway, you have to pass the exam. Every time we cannot have interesting thing in every standard, but at least you have to understand the importance, why they are giving it. Because once you become CA and once you become investor, then you will realize the importance of this disclosure. Or suppose tomorrow you work in some equity research company, then what will you do? You will take the financial statement of a company and then your boss will ask you, you do the research and find out the important ratios. Therefore, this standard will be useful to you. So this standard is much more comprehensive standard than existing AS1. Don't compare it with AS1. It's a wrong comparison also. AS1 only talks about disclosure of accounting policy, whereas this standard Ind AS1 is a comprehensive standard talking about the requirement of presentation in financial statement, where accounting policy is one of the issues covered by this standard. Okay. AS1 only talks about disclosure of accounting policy. AS1 does not talk about the presentation of financial statement. So if you want to compare Ind AS1 with some existing literature, then the closest thing that you can compare it with is the Schedule 3 of the Companies Act. In fact, Schedule 3 was also drafted on line of IAS1 only, so that the balance sheet, P&L account of Indian companies are similar to the financial statement of foreign companies. And now Ind AS 1 is more closer to or very close to the financial statement of international companies now. Okay. So after companies start following Ind AS 1, there will be very minimum difference left between the Ind AS and IAS, and very minimum difference is there between Ind AS and Schedule 3 also. There are differences, but very minimum. The Schedule 3 itself was already designed as per the international format. So first I will discuss some important definitions. Okay. And then these definitions will be used in our subsequent discussion. What do you mean by general purpose financial statement? What do you mean by general purpose financial statement? That means financial statement which are not designed for any specific requirement. Financial statements are not designed for any specific requirement. It is prepared for investors in general. Because there are financial statements which may be specifically designed. For example, you have a venture capitalist. He says, I want information in this format only. Then maybe only to meet his requirement, you may prepare a financial statement which your venture capitalist or private equity investors require. Is it a general purpose financial statement? No. This financial statement can be given to investor, to the bank, to the income tax department, to the company law office, etc. So how will you read it? It is referred to as financial statement are those intended to meet the needs of users who are not in a position to require an entity to prepare reports tailored to their particular information needs. Impracticable. What is the meaning of impracticable? Which is not practicable. Now why we need to discuss this here? You have to apply Ind AS in totality. You have to apply Ind AS in totality. That is, whatever is written in Ind AS, whatever provisions are there, companies are supposed to follow them. Can they deviate? In some rare cases, when it is impractical to apply the Ind AS for whatever reasons. For example, Ind AS may require some kind of valuation, okay, which probably at that point of time you are not able to do. Then you may deviate from the standard, but that is a very rare situation allowed, okay. So impracticable, applying a requirement is impracticable when the entity cannot apply it even after making every reasonable effort to do so. So that one example could be valuation, because most of the Ind AS will say valuation of this item or that item. You may not have expertise to do that valuation. Companies nowadays enter into derivatives, complicated derivative, tailor-made derivative, which are not traded on the exchange. So if it is a tailor-made derivative, that means customized derivative, you do not have expertise to do the valuation. So what will you do? You will say it is impracticable to find the fair value, and hence we are deviating from the Ind AS. What is Ind AS? Ind AS are standard prescribed under section 133 of the Companies Act 2013. What is material? This word you have seen in your accounting standards also. Material would means those accounting information, the knowledge of which might influence the decision maker. The knowledge of might may influence the decision makers. Who are the decision maker? The users of financial statement, like an investor, shareholder, bank, lender, okay. So that is material. Ind AS is applicable to only material items. Ind AS is applicable only to material items. That means do not lose your sleep over immaterial items. Unnecessary, why you waste time for something which is not going to affect anybody. If you purchase a calculator for 100 rupees, now whether you capitalize it or whether you charge it to penal account, how does it matter to an investor if the total sales of the company is 2000 crore rupees, where that 100 rupees calculator has gone? Is it right? Do you need to lose your sleep over that? No, right. So omissions or misstatements of items are material if they could individually or collectively influence the economic decision that users make on the basis of the financial statement. What in AS1 was written long back, material items are those items the knowledge of which might influence the decision maker. What is material depends on situation. If you are doing, suppose, the audit of a big company, Tata Motors Limited, so turnover is some thousands of crores of rupees, and their repair and maintenance expenditure is wrongly debited to travelling expenditure. 1000 rupees repairs and maintenance was wrongly debited to repairs and maintenance, and then you are the auditor, not auditor, article, first year article. Somewhere in your CPT accounts it was given one chapter, rectification of error, repairs and maintenance wrongly debited to travelling expense, pass the rectification entry, travelling expense account debit to repairs and maintenance account. and now you have gone to the CFO of that company and you have said, that's it, this is your company, huh? This is your company, you don't know how to pass an entry. Rectify the error, otherwise I am going to ask my boss to qualify your audit report. Is it right? No, it doesn't matter for them. They will ask your boss, please send someone more qualified. Otherwise next year your rotation will be before 5 years only. That is why nowadays big corporates do a lot of training to their employees so that they don't ask such questions. It affects the goodwill of the firm also. So the size or nature of the item or a combination of both could be the determining factor. Sometimes materiality may depend upon the legal requirement also. For example, the Companies Act says payment made to auditors should be disclosed separately. Is it there? Even if you pay 1,000 rupees and if your company's sales is 10,000 crore rupees, that 1,000 will have to be disclosed in that case, if the law requires you a particular disclosures. Okay. So materiality is very subjective. Materiality is a very subjective thing because you have to see whether this item can influence the decision maker or not. What is material for one enterprise may not be material for other enterprise. What may be material in one situation may not be material in the other situations. Notes. What do you mean by notes? One of the important features of Ind AS is detailed notes have to be given for every disclosures, etc. You prepare balance sheet. In balance sheet, what will you do? At the most, you will write the closing balance of assets and liabilities. You prepare a P&L account. What will you write there? Whatever is the income or expense of that year. But does it give enough information to the decision maker to form an opinion about the risk, return, performance? No. For example, there may be related party transactions. A company has related parties like subsidiary, associate, joint venture, and relatives of key management personnel, the corporates where key management personnel have got interest. Okay. And you have transaction with such entities which may not be at necessarily arm's length. Don't you think this information is to be reported to the investors? Where will you report? In the notes. Or other easy example, you have a contingent liability. Court case is going on. Okay, 200 crore rupees. In case if you lose, you'll have to pay. Don't you think this information should be shared with the investor? Yes. Where will you disclose? Notes to account. Plus you have to also disclose your accounting policies for all significant events, transactions, so that one can compare two entities if their accounting policies are different, right? And many more disclosures have to be given as per different standards. So where are those disclosures given? Through notes. Plus, in case if in balance sheet you have taken aggregate figure, then sometimes some accounting standard or Ind AS will require you should give the breakup of those total figure in the notes to account. Like for example, in balance sheet we'll write deferred tax liability, one single figure. It may be due to several items. It may be due to depreciation. It may be due to some expenditure, etc. So that detail should be given in the notes to account. Okay. So in notes to account is like you give as much information as possible to your investors or users so that they can understand the company better. What are the information given in notes? Narrative description. Narrative, no calculation. Example, accounting policies. Example, accounting policies. Then disaggregation. Disaggregation means the details. For example, balance sheet shows fixed asset. And where is the detail? The detail in the notes to account. There is a note on fixed asset. Opening balance, purchase, sale, closing balance, depreciation, impairment. Okay. Tangible asset, intangible assets, asset owned, asset lease. That is the disaggregation of the item presented in the financial statement. That means detailing and information about items that do not qualify for recognition in this statement. For example, related party disclosure. Related party disclosures is not given in balance sheet, but it is given in the notes. So this is the importance of note. About other comprehensive income, we had a minor discussion in the first chapter, introduction. One of the special feature of Ind AS is that now your profit and loss statement will be divided into two parts. First is called profit and loss, second is called other comprehensive income. This basically includes unrealized gains and unrealized loss item, which now will be presented on the face of the income statement. So that at one place you will get to know how much is your income for the year, realized as well as unrealized. Okay. Owner. Who is an owner? The holder of equity instrument is the owner. And equity will be defined in another standard, Ind AS 32, financial instrument. Who is an owner? That is also a question mark. Are preference shareholders owner? Not necessary. The answer is neither yes nor no. The answer can be not necessary. He may be the owner, he may not be the owner. Suppose I issue a irredeemable preference share. He might be an owner. Again, subject to Ind AS 32, we have not seen that. Or we have issued a redeemable preference share where we have an obligation to pay 10% dividend every year and redemption of principal after 5 years. So this is a clear-cut case of liability. Okay. What is a profit or loss? Profit or loss is the total of income and expense excluding the component of other comprehensive income. So now you have to divide your income statement into two parts, profit or loss, other comprehensive income. What is reclassification adjustment? Tick mark important. This is again something new for you. Something new. You have never heard this term. Reclassification adjustment will arise when some item which was shown in other comprehensive income in the earlier year is now recognized in profit and loss account. So it is recycling from other comprehensive income to P&L account. So earlier it may be unrealized, now it may be realized. But about it you have to study first other standards. Unless you read all standards, you will not understand and remember which item needs to be recycled from other comprehensive income to profit and loss account. Okay. But at least you got the meaning. These are those items which will be reclassified from OCI to P&L account. But for understanding those individual items, you will need to study other standards also. And what is total comprehensive income? It is the sum of the P&L account and other comprehensive income. Sum of the P&L account. P&L account shows income, other comprehensive income also shows income. So it is a total of both, which is called total comprehensive income. Total comprehensive income is the change in the equity during a period resulting from transaction and other events other than those changes resulting from transaction with owners in their capacity as owners. So it is both realized and unrealized profit. That is why now the format is P&L account plus other comprehensive income, so that during the year how much is the net addition or net deletion to the equity is given by this total comprehensive income. And what is a financial statement? Financial statements means a structured representation. Sir, what is structured? Means it's a standardized format. You now cannot draw format in any format you want. You will say in 11th, 12th we used to write like this, balance sheet. Okay, cash, cash idhar hai. Cash. Example, some people used to write here also. Then capital plus profit. Now you can't write like this. You will follow a standardized format which will show financial position means balance sheet and financial performance means income statement, total comprehensive income statement. Now this question you tick mark for a theory question. What is a complete set of financial statement under Ind AS? Or what are the components of Ind AS financial statement? 5 items. How many items? 5. You know balance sheet, you know statement of profit and loss, You know statement of cash flow and you know notes. What is new thing now? Again, you will double tick mark. Statement of changes in equity. Actually speaking, it is not new. Earlier we used to write one heading called reserve and surplus. Now what I'll do, equity share capital plus reserve and surplus will prepare a statement where we will write opening balance brought forward from last year, addition, deduction, closing balance. So we were doing the same thing in reserve and surplus. We are doing the same thing in reserve and surplus. There is nothing great about it. The same thing you have to write now at one place in a format. You have to write the column heading, general reserve, P&L account, securities premium, capital reserve, etc. etc. Jitne reserve, utne column. And then opening balance and whatever plus minuses which have taken place in that account during the year, that you have to present, so that one can see the movement in each reserve properly in that standardized format. Okay. And notes, which will contain summary of significant accounting policy and any other explanatory information. The total number of pages devoted to notes is many times more, 40, 50 times more, 30, 40 times more than the total pages dedicated to first 4 items. True or false? True. And you will become CA. So tomorrow you will also have to prepare the same notes if you work in the accounts department of an Ind AS company, which you will. Yes or no? No. Why? You'll do your own practice. Then you have to audit. That means auditors will have to now do it for 20 companies. If you have 20 clients, for all 20 companies you have to review the notes to account. Is it right? And then you will say, no, I will only take small clients which don't follow Ind AS. But your small client may be an associate or a joint venture or a subsidiary of a big company. So you are under Ind AS. You can run, but you cannot escape. Okay, so you have to either on this side of the table or on the other side of the table. You have to learn Ind AS. You are having no choice now. The only choice is IPL. Become a cricketer, movie star. Okay, now that is also not possible. You have become little old now. Why are you laughing? Can you start matches now at this stage? Your juice has already been squeezed out fully in last 3 years. One more interesting feature, tick mark, which you have not done before in your life, is 3 balance sheet concept. Concept of 3 balance sheet. What is the concept of 3 balance sheet? Suppose, for example, our year ending date is 31st March 18. So this balance sheet I have to give. I have to give a comparative of last year. This also I have to give. In some situation, you will be required to give one more balance sheet, that is the first day of the previous financial year. First day of the previous financial year. When will you give the third balance sheet? The third balance sheet will be given by the company when any of the following 3 situations occur. So that is another 3 question for you. When is opening balance sheet of previous year required to be given under Ind AS? When is the opening balance sheet of the previous year required to be given under Ind AS? So you will say opening balance sheet is required for the earlier period if a company changes accounting policy with retrospective effect. See the fun here. Company in India used to change accounting policies, okay, because they wanted to bring a desired change in the either profit or balance sheet. Now if you do under Ind AS, and if that accounting policy is applicable from retrospective effect, you have to go to that year. Suppose the retrospective effect is to be given from 2007. So from 2007, start giving the effect. Find out what would have been the balance on 1/4/16 and prepare that balance sheet. After giving the effect of that change in accounting policy. So you might have to restate the figure of 1/4/2016. Then using this balance sheet, prepare this balance sheet. And using this balance sheet, then you prepare this balance sheet. So it is like a deterrence. Sir, what is deterrence? That means it is like, suppose deterrence, another example. You are walking near a home. There is a board written on the gate. Beware of dog. Anything can happen. Okay. So that is a deterrence. You will not try to trespass that. Because there is a dog inside. Most of the time dog is not there. Okay. But that is a deterrence. That is a deterrence. So that outsiders will not try to interfere. So when I put such clause in the Ind AS, it is a deterrence. Companies will not try to change the accounting policy because then they have to again prepare one more set of balance sheet. And you know it takes a lot of time, energy, effort and resource to prepare a balance sheet fully. It's not an easy task for corporates. And these are already big corporate because their turnover is net worth is 250 crore, 500 crore. So obviously they are overburdened. So therefore they will change the accounting policy only when it is extremely urgent. Okay. There is a punishment. Makes a retrospective restatement. Suppose there is a error committed in earlier year and now it is discovered in this year. Under our accounting standards, what we do? Very simple. In the current year P&L account, write one line item, prior period item, chutti. Ind AS says no. The error was committed in 2013. Go to 2013. Adjust that figure. When you adjust that figure in that year, it will affect the balance sheet figure also. Some asset, some liability, some reserve will get affected. Bring it forward, bring it forward, bring it to this date. Prepare one more balance sheet on 1/4/2016. Are you getting? Don't commit error. That is my second message. Don't commit error or omission, otherwise punishment is severe. There is no concept of prior period item to be shown in the current year P&L account and get rid of your responsibility. You have to be more responsible now. Okay, otherwise prepare one more balance sheet. And then the management will call you and ask you why you should be continued in the company. And when it reclassifies an item in its financial statement, reclassification. Okay, maybe from fixed asset to inventory. Can we reclassify? Yes, if suppose my objective of business has changed. So I was earlier having 10 cars, which I was using for my only business purpose. Okay, one car I was using, one car my manager was using, 2 cars my staffs were using, 3 cars my teachers were using. But then one day I thought, let me start car business only. Possibly. Ola. Whatever. That's good idea. It is any case, it's lying vacant throughout the day, unused. Okay, so in the meantime, maybe I can earn some extra money out of it. I'll just employ somebody. If you are free, you can just please meet me after. Because you got the idea. Means you are searching for such business employment. Yeah, partnership, profit. You will take 10%, I'll take 19%. Plus you will bear the petrol also. So now we'll come to 3 balance sheet concept. 3 balance sheet will be required. 1, change in accounting policy from retrospective effect, restatement of a item in the financial statement retrospectively, or reclassification of an item in the financial statement. So then we have to prepare like this. As I said, suppose my year ending date is 31st March 17, previous year as usual. This is the requirement in every standard, plus special requirement. If any of the three things you do, then you have to also give one more balance sheet on 1/4/15. General features of a financial statement. This is very general discussion, but it is a part of Ind AS 1. What care you have to take when you are preparing financial statements? First is, financial statements should present true and fair view. That is the way the things are, you should present them. It should not be biased. That is the meaning of true and fair, unbiased. You should not try to influence the figures in the financial statement. Okay. In Ind AS, true and fair means the financial statements are prepared by applying all Ind AS which are applicable to the entity. So financial statement shows true and fair view here. Now we'll come to specific. Financial statement will show true and fair view here in the standard if they comply with the requirement of all applicable Ind AS without any change. Without any change. So read the first line. Now, in case if they ask some question from Ind AS 1, what is true and fair view as per Ind AS 1? And then you have started your own story for 2 pages. But you didn't write this one line. A financial statement is true and fair if it complies with all the requirement of all the applicable Ind AS. That sentence you have not written, and everything else on earth about true and fair you have written. General presentation of true and fair view of financial statement is presumed to be achieved by application of all relevant Ind AS, whatever is applicable to your entity, along with additional disclosure. And one more thing they have done now. Tick mark this line if it is there. It must be there because I have prepared the presentation from this book only. Now companies will have to write in their notes one line. All Ind AS have been complied with. Unreserved statement, unqualified statement, okay, explicit statement. Did we used to write that all accounting standards have been complied with? No. That auditor used to write in the audit report, based on our report information blah blah blah, company complies with all the accounting standard, all the laws, all the ये वो सब कुछ लिखते थे. वो भी pre-printed form रहता, only is just signs it. No. आप भी ऑफिस में ऐसे ही करते हैं ना. यू टेक सम लास्ट ईयर फॉर्मेट, जस्ट यू टेक अ वाइट इंक, चेंज द नेम ऑफ द कंपनी, डेट, एंड अगेन इशू. नो वाइट इंक. नाउ यू कैन टेक अ न्यू प्रिंट आउट. ओके, यू आर अ रिच कंपनी. So you have to give us explicit statement that we have complied with all. Suppose you give a disclosure that we have not complied with some Ind AS, or you have not followed some Ind AS, then it means your financial statements are not Ind AS compliant. Your financial statements are not Ind AS compliant. Okay. Any departure from Ind AS, any deviation from Ind AS will make your financial statement non-Ind AS compliant. That is another very strong thing about this Ind AS thing. So departure from complying with the prescription laid down in the standard. What is written here? In extremely rare circumstance. Extremely, it's already a very strong word. And then rare, another very strong word. Extremely rare, rarest of the rarest situation, the entity may find it appropriate to make a departure from complying with the prescription laid down in the standard. It's very difficult to give an example also. What example I can visualize? Suppose you have entered into a complex tailor-made derivative. Complex tailor-made derivative product. Okay. And it is not traded on the exchange. Standard says derivative should be fair valued. Ind AS 109 says derivative will be fair value. Arey bhaiya, but somebody should do it. Somebody should find the fair value, na? And such derivative was never created before. There is no market. There is no expert available who can really find the value of such derivative. Then you cannot do it. Then you have to deviate from the standard. You cannot do the fair valuation. That is example which I can visualize. So departure from complying with the prescription laid down in the standard. This may happen in cases where the management concludes that complying with the requirement in Ind AS would be misleading, in which case entities shall depart from the requirement of such in such manner as described below. So in rare cases departure is possible, but then what are the requirement of departure? Suppose you are departing from a standard. In our example, I said the derivative should be valued at fair value. I cannot do the fair valuation because I don't have expertise. I can't find other expert who can do that. So where the management is of the opinion that, suppose you are departing, that presentation of true and fair view of financial statement is achieved only with a deviation from a particular requirement, and such deviation is required or not prohibited by the regulatory framework. Now please understand, deviation is allowed only if it is allowed by the law. Deviation is allowed if it is allowed by the law, means law does not prohibit deviation. But if the law prohibits deviation, then deviation is not allowed at all. Companies Act, suppose, does not allow deviation, then you cannot deviate from the requirement of Ind AS. And if you do, your financial statements are not compliant with Ind AS, not true and fair view. Correct. In your book, you'll find there are two columns I have written, situation 1 and situation 2. Situation 1 is where the law allows departure. Law allows deviation from the Ind AS. In that case, what are the requirements? Okay. The entity can make the deviation from the requirement of a particular standard if it is allowed by the law. But in that case, what you have to do, you have to write a note in the notes to account. You have to disclose that financial statement shows true and fair view of financial position, performance and cash flow of the entity. Then you have to add one more line. It discloses that requirement under the standards have been complied with except for the particular requirement. So that disclosure you have to give. That particular item where you have deviated from Ind AS. Okay. Give a description of the title of the standard. Suppose in my example I am saying fair value of derivative could not be arrived at. So you will say under Ind AS 109 fair value of derivative is required to be ascertained, but we could not. And the accounting treatment required under the standard. The nature of departure and the reasons justifying the compliance with the requirement would be misleading. You will say that in case if I do fair valuation, it may be misleading because we don't know. Financial effect of this departure will be presented. Wherever possible, quantify the effect of deviation. Situation 2 is when the law does not allow deviation. If the law does not allow deviation, you cannot deviate. You cannot deviate, matter closed. Okay. You can only give a disclosure that we wanted to deviate, but we cannot because the law does not allow. Okay. So this is for deviations. Now companies will have to give a disclosure about going concern assumption. What is a going concern assumption? The same thing which is taught in basic accounts class, that the entity has neither the intention nor the necessity to liquidate or substantially curtail the scale of operations. Is it right? The entity has neither necessity nor intention to substantially curtail or liquidate the activities. Okay? An entity is required to make an assessment of its ability to continue as a going concern and prepare the financial statement on going concern basis. So it is assumed that financial statement is based on the assumption of going concern. Now, how does it matter? If it is going concern, then you apply all Ind AS, especially where historical cost-based accounting is required, like in property, plant, equipment standard. You can continue to do accounting of property, plant, equipment at historical cost. If you are going concern, follow historical cost accounting. But if your company is no longer a going concern, then we deviate from the traditional accounting method. Unless the management either intends to liquidate the entity or cease trading, or has no realistic alternative but to do so, then in that case financial statement will not be present using your normal accounting principle. You may have to follow other principles, like fixed asset may be now valued at realizable value. Okay. In this situation, the entity shall prepare the financial statement by adopting other appropriate basis of accounting supported by disclosure, covering the basis on which financial statements are prepared. So mostly you will follow now realizable value accounting once the going concern is no longer valid, and the reason why the entity is no longer a going concern. While evaluating going concern, you have to take a 12 months view. How many year or month? 1 year or 12 months. That is, at least for 1 year or at least for 12 months, the company is a going concern. If you think the company may not remain a going concern in the next 12 months, going concern assumption is no longer valid. You have to change the basis of accounting. Another requirement of Ind AS 1 is that financial statements should be prepared using accrual method of accounting. Accrual method, all of you know, income should be recognized when it is earned. Expenditure should be recognized when it is incurred. When is income earned? When your right to receive the payment is established. Expenditure is incurred when an obligation is created. Actual receipt or payment is not necessary. However, one statement will be prepared on cash receipt and cash payment basis, and that is called statement of cash flow or cash flow statement. Next is materiality and aggregation. Have you seen trial balance of some very big company? If you have audited some listed company, you'll find trial balance runs into hundreds of pages. If not 100, 40, 60, 70, 80 pages. Are we going to write all these items in the financial statement individually? No. Then what you have to do? Aggregate. So for example, even under the head employee benefit, there are many accounts they open. There is one salary account, stipend account, PF account, gratuity account, okay, or leave encashment account, etc., etc. Many types of benefits they give. Individually they open an account for each of these benefit. But do you find all these items in the balance sheet of a company? What do they do? Aggregate. Similar items are aggregated. Okay. So while doing aggregation, you have to keep materiality in mind. Both extremes should be avoided. One extreme is all items are added together, one item. Is it right? Other extreme, every item is shown separately. Too much of detailing is also not required. Say for example, in your P&L account is written to pen purchased, to notebook purchased, to eraser purchased, to stapler pin purchased, to box file purchased, to flat file purchased. I'll stop here. You understood. Who requires so much of detailing? Does investor want you to disclose flat file purchase, box file purchase, pen purchase, pencil purchase? Right, printing and stationery. Okay, that is just an extreme example, but you have to be careful while aggregating also and while disaggregating also. That requires really skills, because you have to only give limited number of items in the financial statement. The item of dissimilar nature or function should also be presented separately. So salary and printing and stationery you can't club together. Can you? No. Now next is some discussion on offsetting. First thing, many standard will themselves talk about offsetting. So first thing what they are saying in the third line here, offsetting will be done only if it is allowed by respective Ind AS. Example of offsetting, suppose I have a debtor, Mr. XYZ is our debtor. Mr. XYZ is also our creditor. Is it possible the same party can be a debtor or a creditor? Yes. I purchase notebook from AK Enterprise. I sell him audit book to AK Enterprise. So when I purchase notebook from him, he is my creditor. When I sell him audit book, he is my debtor. So on the asset side, 2 lakh rupees appearing receivable, liability side 5 lakh is appearing payable. How do I present it? One option is 5 lakh, 2 lakh. The other option is 3 lakh creditor. So I will not answer this question now, because for that you have to go to Ind AS 32, presentation of financial instrument. Debtor and creditor are financial instrument. So that answer I will give you. I'll give you this answer. But once we reach Ind AS 32, you have a bank overdraft with ICICI Bank, and you have a term loan account or fixed deposit account also with ICICI Bank. Can you net off? We'll answer that question later. Is it right? So you have sold a fixed asset. You earned 7 lakh rupees. You incurred 30,000 rupees brokerage. So will you present 7 lakh rupees profit on sale of fixed assets separately, 30,000 brokerage incurred separately, or net amount in the P&L account? So all these questions will be answered by the respective standards, not now. Some examples are printed there if you see. Netting selling expense with the sale proceed of fixed assets sold. So it can be netted off. Foreign exchange gain on some item, foreign exchange loss on some item. You can just find out the net gain or net loss and write one item in the P&L account, net foreign exchange gain or loss. You can net off. See, one question also I have written there, solve. Don't turn the page. Statue. Wherever you are. X Limited sold an item of PPE, selling price 100, cost 85, accumulated depreciation 15. Don't look at the answer. Selling expense is 2 million. Otherwise, from the next time, I will not give you the answer. You want answer or you don't want answer? Don't want. Okay. No, you said we don't want answer. Gain on sale of property, plant, equipment. Your institute is so kind that given the answer also. This is your cost, this is depreciation. So WDV 70. 100 selling price, 70 WDV, 30 is the profit, and 2 is selling expense. So the question they are asking is, can the company present 30 lakh separately and 2 lakh expenditure separately, or they should only present 28 lakh net profit in the P&L account? Okay, so the answer is gain on sale of property, plant, equipment rupees 30 million can be presented net of selling expenses of rupees 2 million as per Ind AS 1. So wherever offsetting is allowed, you can do it. Now one more question. Basic question on Ind AS 1. During 2014-15, X Limited created a provision for warranty claim of rupees 5 million under Ind AS 37. What is Ind AS 37? Provisions, contingent liabilities and contingent asset. Reimbursement as per Ind AS 37 is 2 million. Now, even if you have not studied Ind AS 37, don't worry. The same provision is there in Accounting Standard 29 also. On one hand, you make a provision for warranty. You are a dealer of refrigerator. You're only a dealer. You sell 100 refrigerator and you give a warranty to your customer. Something goes wrong, come to me, I'll repair, replace, rectify. At the end of there, what we will do, we'll see how many goods were sold, how many warranties still outstanding, I'll estimate the expenditure, make a provision. At the same time, my manufacturing company says whatever expenditure you will incur, we will reimburse you. So I will also recognize reimbursement. Now I have two accounts in my trial balance. Provision for warranty 5 million, reimbursement receivable 2 million. Can I present net amount in the P&L account? The answer is yes. So in the P&L account I will only present 3. Provision net of reimbursement 3. It is allowed by both AS 29 also and Ind AS 37 also. What about frequency of reporting? Current year, comparative figure of last year, and in those 3 situations, one more balance sheet will be required. Which 3 situations? Change in accounting policy from retrospective effect. Second, any rectification of any prior period items, okay, and then reclassification, restatement, reclassification, and change in accounting policy. So a complete set of financial statement needs to be prepared at least annually. At least annually. But listed companies are required to prepare quarterly. If the time gap between 2 periods other than for interim reporting is shorter or longer than annual period, the entity shall disclose the reason for adopting such a longer or a shorter period and mention the fact that the amounts are not entirely comparable. Is it possible to have more than or less than 12 months? Sometimes yes. For example, till last year, our year ending date was 31st December, and now the company moves to March. So this is, let us say, 18. So immediately I will not close my books on 31st March 19. Will I? Only 3 months? No. So what I'll do, I will now directly close my books on 31st March 2020. So it will cover how many months? 15 months. So this is more than 12 months. This is more than 12 months. I can take it. Comparative will be given 31st December 18 with a note that these 2 balance sheet or P&L account or cash flow statements are not comparable. Less than 12 months. My financial year ending date is 30th June 18. Now what I did, I made it 31st March. So I decided to close my next financial year on 31st March 19. How many months it covers? 9 months. It covers 9 months because I have changed my year ending date from 30th June to 31st March. 9 months. Previous year is 12 months. Not comparable. Make a disclosure. Government is also thinking that in India now we will take 31st December as an year ending date. Then this clause will become applicable to many companies, because then that year their financial statement will cover only 9 months. Another source of income for our CAs. Okay, now this is a CA friendly government. Okay, one more revenue churning opportunity is coming soon. Change in year ending date. Frequency of reporting. Financial information shall be for a minimum 2 period. Current year, comparative figure of previous year. All statements have to be given in comparative form. Comparative balance sheet, comparative profit and loss, comparative cash flow, comparative notes also. Comparative information shall be presented in respect of previous period for all the amounts reported in the financial statement for the current period. So whatever you have reported in current period, its corresponding previous year data will be given. And this line is repeated. Additional balance sheet. Additional balance sheet will be given when there is a change in accounting policy with retrospective effect. There is a retrospective restatement of an item in financial statement, or the entity reclassifies an item in the financial statement. So now there will be 3 balance sheet given to you. Current year, previous year, and opening balance sheet of previous year. Change in presentation or classification. When there is a change in presentation or classification, then you have to also change the presentation and classification of previous reported period also. Why? Comparison. Last year it was shown as inventory, now this year it is shown as fixed asset. So how you can compare the two financial statement? Okay. Where there is a change in presentation or classification of item of financial statement, comparative information are also reclassified. Task of accountant is increasing now. If you change something in this year, you have to also change the previous year data in the same format, so that the two data can be easily compared. And you have to also disclose the reason for reclassification. So management also has a duty to give the reason. Nowadays, we are living in a world where shareholders are very active, okay, very demanding. And if they find that management is doing something wrong, they will ask a question also, that why you have done this, and then you have to give a reply to that shareholder. So therefore, changing accounting policy, making error, reclassification, these will become things of the past. Why? Lot of disclosures and adjustments are to be done. When reclassification of comparative period is impracticable, I have discussed impracticable, when it is almost impossible to do it, an entity shall disclose the reason for not reclassifying the item and the nature of adjustment that would have been made if the amount had been reclassified. Now we'll solve one more question. Today, X Limited found a material error in its financial statement for year 2011-12. Very simple. You are into 14-15. Error was located which relates to 11-12. Which relates to 11-12. Now this is a question for you. What will you do? You will say, I will prepare 3 financial statement, 3 balance sheet. 31st March 15, 31st March 14. दो तो वैसे भी देना आपको. You have to give 2 in any case. And 1 for 14 also. 14 or 13? 13. The opening day of the previous financial year. So one balance sheet will be given on 1/4/13, opening day of the previous year, after doing rectification in that year and carrying forward the balance to 1/4/13. Then that balance sheet, make adjustment 31st March 14. That balance sheet and 31st March 15. Now we'll continue.